What's up, everybody? My name is Joe Brown. This is Heresy Financial. This year has blown away previous year's records on insider selling, obviously sparking controversy considering that some of the biggest sellers are some of the biggest billionaires. But we've seen something else pick up this year that's a little bit odd. Company share buybacks have also been increasing a lot. And while it may not seem clear at first, these two are interconnected. And ultimately, they are enabled by the Federal Reserve. It's an age-old game being played. Central bank easy monetary policy both enables and incentivizes insiders selling assets at the top. And in this video, I'm going to show you why. Ready? Let's dive in. All right, so we've seen a few records hit this year regarding insider selling. The first one is that to date, we've seen almost $70 billion worth of insider selling take place in 2021. To put that into perspective, that's up about 79% compared to the last 10-year average. But despite all the selling, stock prices continue to climb. So if the biggest insiders are selling, then who is buying? Well, it turns out it's not just the little guy turning into a bag holder. It's actually the company itself. As you can see here, share buybacks have rebounded majorly. Obviously, they experienced a steep drop-off during the beginning of 2020, but have recovered strongly. Now, these share buybacks have enabled insiders to sell without causing a panic and a mass exodus out of the shares because there's enough demand coming from the company itself to soak up the selling. So before we can understand how this traces all the way back to the Federal Reserve, we need to understand a little bit about buybacks themselves. So why would a company want to buy back its own shares, especially if insiders are selling? Well, first, it is an easy way to reward shareholders. You buy enough shares, pull them off the market, that drives the prices up, all else being equal. Second, it is a great way to have a very easy ROI on the cash that you're spending compared to something like R&D. You might spend something on something that doesn't actually turn out to be profitable for your company. Just buy back your shares, drive that price up, instant ROI. Third, it decreases the number of shares that are outstanding, which means it improves the fundamentals. So take this for an example to understand what I'm talking about here. You've got a company, let's say they make $100 million. They've got 1 million shares outstanding. That is an earnings per share of $100. Now let's say they engage in some share buybacks, and let's just say for the sake of the example, they buy back 500,000 shares. They soak up half the shares that are outstanding. They still make the same amount of money, $100 million, but now to find your earnings per share, you're only dividing that by 500,000 instead of 1 million. That means your earnings per share just doubled to $200. So without doing anything to improve the business, you just doubled your earnings per share by buying up half the outstanding shares. The fourth reason that a company might engage in share buybacks is because cash is both easy to get and costly to hold during times of inflation. So if cash is flowing in, and costs are rising, so you don't want to hold on to that cash, you want to spend it on something, and it's risky to spend it on something that might improve the business or might fail to improve the business, there's a high incentive to just purchase your shares with that cash. And the fifth reason that a company might buy back shares is because debt is cheap. And so even if you don't have all of the extra cash, you might finance the purchase of your shares because that will do all the same things as before, improve your fundamentals, reward your shareholders, and the cost of servicing that debt would likely be cheaper than the ROI that you get from your share price going up. Now, if you haven't already started putting the dots together, this is where the responsibility that lies at the Federal Reserve, this is where it starts coming into play. We know that easy monetary policy expands the money supply through two different mechanisms, the banking system and the government. Through the banking system, lower interest rates means that banks must increase their lending in order to just maintain their revenue. Through the government, when the government spends money, they have to get that money from somewhere, and if they can't get it all from taxes or borrowing out of the economy, then they have to borrow it from somewhere, and that money ultimately comes from the Federal Reserve. So when the Federal Reserve monetizes government debt, when they fund government deficit spending that is in excess of what it can borrow out of the economy or tax out of the economy, that is spending money into existence. Now, as this new money comes into existence, it's spent on goods and assets. People will spend that money on goods to front run inflation. They'll buy stuff, right now because they know if they wait, it'll go up in price later. And people buy assets because they know that the price rise will be somewhat of a hedge against inflation. They can sell that asset at a later time, maintain at least some of their purchasing power. Now, when that new money is spent on goods, where does that ultimately end up? That cash ends up in the hands of companies. So an inflationary environment does increase revenues for companies, but that cash becomes more costly to hold on to, so it must be deployed. But it's not just a matter of the new money coming into existence, working its way throughout the economy, landing on company balance sheets, incentivizing those share buybacks. It's also the fact that debt is cheap. Banks are wanting to lend money out. Companies see this and they say, that's cheap debt. I want some of it. And while the cost of servicing that debt might increase your costs as a company, usually the benefits to buy the stock outweigh it. And all this happening causes the smart people, the insiders, to look at this and say, might be time to cash out, at least just a little bit. And that's what big investors and insiders are doing right now. Because ultimately, this is a game that can't last forever. And now with the taper in play, it's only a matter of time before things reverse. And like I said, this isn't anything new. You can see these same patterns repeat over and over throughout history. My favorite that I talk about frequently is John Law 300 years ago in France. He controlled the central bank in France. He issued paper money that was backed up by gold, silver, and land through the shares of his Mississippi company owned land in America. As the confidence in the currency started shaking, he needed to increase that confidence by boosting the value of whatever backed up his currency. Couldn't really do that with the gold and silver because he had already confiscated it from everybody in France. So what he ended up doing was printing more currency to buy shares of the Mississippi company to boost the price. Now, the smart investors saw what was going on and they said, hey, this is like two boats sinking next to each other, bailing water out from one into the other. So they obviously started selling the shares, which puts downward pressure on the share price. And so in order to combat that, John Law had to print more cash, use that to buy up all the shares that people started selling to stop it from tanking the share price, which made even more people realize that no matter how many shares they sold, it wouldn't push the price down because he would always print more cash to buy up all those shares at the artificially high price. So easy monetary policy created the conditions that allowed insiders to sell their assets at artificially high prices. And it kept asset prices high enough to support all the selling. There's nothing new under the sun. Oh, and one final note, the ones who got rich from this were the ones who took their profits and bought gold and silver. The most famous of these was Richard Cantillon of the Cantillon effect. And if you'd like to know my recommended sources for buying gold, silver, or Bitcoin, I've got affiliate links in the description below. As always, really appreciate you guys. Thank you so much for watching. Have a great day.